Hey guys, how are you all doing? Welcome to an amazing session on Ind AS 12. Guys, we are going to be seeing a part of Ind AS 12 today which many people tend to skip, or many people don't understand, or they try to understand but in vain. Guys, this part of Ind AS 12 which we're going to be discussing is effective tax reconciliation, ETR. So, those who are doing your articleship in audit, you might have heard of this term. Some of you might not have heard of this term, but it's a very relevant and important concept for CA final, and it was last tested in November 2022. So there's a high probability of being tested in your May 25 exams, guys. So what are you waiting for? Buckle up, sit back, relax, and enjoy to this one. So, guys, effective tax reconciliation. What, why, and how? First, we look at the theory aspect of it. Guys, what is effective tax reconciliation? Guys, to understand this, let's go back in time and see a story. Guys, first, first up, let us say there are many users of a financial statement. So there will be investors who are one of the users of financial statement. Guys, do you think all the investors are qualified CS? They know what is Ind AS 12, they know what is effective tax reconciliation? No, you can't expect them to know that, right? So let us say the profit before tax PBT is rupees 100, and let us say the company is in an alternate tax regime under 115 BAA or maybe 115 BAB. So the effective tax rate that would be applicable to the entity would be 25.168%, or rather, if I have to put it simply, it would be 25.17%. An investor would be like, boss, you've earned rupees 100 of profit. So ideally, your tax liability should be rupees 25.17, which is basically 100 into 25.17%. But guys, just pause, think for a moment. Is this logical? No. Why isn't this logical, guys? Because your profit as per IT Act need not equal profit as per books of accounts, schedule 3. Why is the reason for this, or what is the reason for this? It's very simple. In your income tax computation, there is a difference. Like, for example, let's take a simple case, depreciation. In depreciation, in you can, as per your Ind AS 16, you can either take your SLM or WDV. But in Income Tax Act, most of the cases, the companies will have to adopt WDV unless they are a power generation unit. So this is one difference that might arise. Another scenario, your Section 43B items. In income tax, this will be allowed as a deduction only on payment basis. While in your books of accounts, you will be taking the accrual as a deduction while arriving at your profit before tax. Okay, let's take some other item, CSR, corporate social responsibility. So, in case of your 115 BAA and BAB, the entity won't be eligible for ATG deduction, right? Perfect. So, in this case, the CSR will be added back in the current tax for computation. But in your books of accounts, while you arrive at your profit before tax, the CSR expenditure is going to get deducted. So, we have seen some of the reasons as to why our profit as per Income Tax Act will not equal to the profit as per books of accounts. So, I have to go back a bit in time and also explain the logic for deferred tax so that you understand the complete picture. So, let us say there is company A and there is another company, company B. Company A has a loss of 100 and company B has a profit of 20. Current tax, which company A might be paying, might be, let's say, 50 rupees. But, but, current tax, which company B might be paying, might only be, let's say, 40 rupees. This is possible. This is practically possible because you might have a loss in your books of accounts, but you might have a profit as per your current tax computation. It is very much possible because, let's say, the loss in company A might have arisen because of a big impairment loss that they might have booked. Again, an impairment loss is not allowed as a deduction in your tax computation. It'll be disallowed like an impairment loss on an investment. It's not going to be allowed in your tax computation. It is going to be disallowed, added back to your computation. So let's say you arrive at a profit for company A as per your current tax workings, and you will have a current tax liability there. For company B, you will have a current tax liability. But let's say an investor looks at this. An investor who does not know what is Ind AS 12 or AS 22 might be like, what is this? Company A is in loss, but it's ultimately paying more tax than company B, which is in fact in a profit. So this confusion might arise, which is why we brought in a concept called deferred tax. Yes. So to give you a perspective, when deferred tax comes into picture, what will happen is, let's say the profit of the entity is 100. Let's say the tax rate applicable to the entity is 25.17%. Assuming, just keep this in mind, assuming that there are no permanent differences. Assuming that there are no permanent differences, your tax charge should be rupees 25.17. This will be bridged through current tax and deferred tax. So what will happen is, in an ideal scenario, let's say a company does not have any permanent difference. Like for example, CSR is a permanent difference item in case of a company that opts for alternate tax regime. In such a case, the rate which we take, that is 25.17, and the rate which we apply on the book profit will perfectly equal to the current tax plus deferred tax total. How is this possible? Yes, let's take an example. Let's take a very simple example. Let's say profit as per books of accounts equals 100. Let's say I have only one tax adjustment for simplicity purpose. Let's say as per section 43B, my P&L charge is rupees 20. My payment made during the year is, let's say, rupees 15. So for simplicity purposes, let's say this is a provision for gratuity. Let's say there is no movement in OC for simplicity purposes. So let's say I have an opening provision of 0. Let's say I have a P&L charge of 20. Let's say I have a payout of 15. So ideally, my closing provision would be rupees 5, right? So in our current tax computation, what would we do? We'll start with the profit as per books of accounts, 100. We'll add back the P&L charge, right? Because it has to be disallowed. Then we'll reduce the payment because it's allowed as per section 43B, assuming that it was made within the due date for filing of your ITR. So in this case, you will have a current tax profit of rupees 105. Let's say on this you apply your 25.17%. So what do we get? Just a moment. 105 into 25.17 divided by 100. Okay. So we get a current tax charge of 26.4285. Let's say I round this to 26.43. Now guys, coming to our deferred tax computation. What do we do here? So guys, you know that in your tax books, your gratuity provision is not even recognized in the tax books as a balance sheet item, right? Because your provision which is coming is only there in your books of accounts. So your gratuity does not have a tax base. Tax base is nil. And your book base is coming from here, boom, rupees 5. So guys, I'm pretty sure that you know what is a book base, what is a tax base. I'm not going into the details of that. In case you need a video on that, just comment down below and I'll definitely make a video on that. So guys, here gratuity is a liability. So for a liability, if my book base is greater than tax base, just think carefully, think logically. Will it be a deferred tax asset or a deferred tax liability? It will be a deferred tax asset, guys. Again, this is something basic. I think assuming that you all have read this standard, this is going to be very logical to understand. In case you don't understand, again, I will make a detailed video on the logic for when it's a deferred tax asset, when it's a deferred tax liability, but I feel it's too basic considering that you would have already gone through the standard once. So you will create a deferred tax asset. So on what amount will you create a deferred tax asset? So 5 rupees into 25.17, you will create a deferred tax asset. So 5 into 25.17 divided by 100, you have 1.2585. So guys, so our current tax charge was 26.4285, but our deferred tax credit, why is it a credit, guys? Because you have a deferred tax asset, and what is the entry you will pass to create a deferred tax asset? You will debit your deferred tax asset and you will credit your P&L of deferred tax, right? So when your P&L is getting credited, it is a credit to your P&L, and hence it's not a deferred tax charge. Very simple. So now what is my net tax charge in my P&L? So it is basically current tax to the extent of 26.4285, and my deferred tax credit, because I'm having a deferred tax asset now, deferred tax credit to the extent of 1.2585. So what do I get? 26.4285 minus 1.2585. 25.17. Whoa, that seems like magic, right? It's not magic, it's just logic. And I think I just explained the logic. I just took some random numbers on the spot, did that, and I proved that to you that when you don't have a permanent difference, when you only have a temporary difference, the effective tax rate that you apply on your book profit will yield a tax charge which will equal to the summation of your current tax charge and your deferred tax credit or your deferred tax reversal, as the case may be, or you might even have a current tax credit. Anything is possible. So ultimately your current tax plus your deferred tax will equal to the tax rate that you apply on your books of accounts when you don't have a permanent difference, right? Very simple. So basis, when we explain this to a layman, he will be able to understand. He will be able to picturize. He will be able to see that, okay, I am taking 100 rupees of book profit here. When I just go up here, I have 100 rupees of book profit. He will be like, he'll take 25.17%. He'll get a tax charge of 25.17. He'll be like, whoa, it's matching. It's current tax 26.4285 minus deferred tax 1.2585. He doesn't care as to what is current tax, deferred tax. He doesn't know any of it. What matters to him is ultimately is the tax charge coming to 25.17. Yes, okay, cool. I am happy. So everything is fine in the company. That's what his mindset would be. But the story doesn't end here. It doesn't end so simply, right? The climax has to be interesting, right? So we are approaching the climax and the beginning of something new. As they say in Drishyam 2, like this is the start of something that is going to be really serious. Yes. So into business. So permanent difference. When we have a permanent difference, this will not be the case, guys. This will not be the case. So I will explain this again with an example as to why it will not be the case when we have a permanent difference. So same example, guys. Let's take the same example, except that let's just say that we have a CSR expense of rupees 20. Same numbers as above, the same 43B numbers and all that stuff. So only change that will come, guys, in my current tax computation, current tax working. So what did I get earlier in my current tax working? So I got 105 of tax profit. So I have 105 of tax profit, but I'll add back 20 of CSR. 20 of CSR would have been deducted in my books of accounts to arrive at my profit before tax of 100. Let's say, assuming that the 100 is after deducting 20. So this 20 is a disallowance because you don't have, you're in 115 BA and BAB and you don't have the privilege to take it as a deduction. So you will have a current tax profit of 125. Now let's say you apply 25.17% on it. What are we going to get? 31.4625. Perfect. Yes. Now, deferred tax. Guys, very basic question. Will we create deferred tax asset or deferred tax liability on a permanent difference? Simple answer, no. Yes, if I have to explain the logic behind this, I have to start again from scratch, assuming that you know this. We are just parking this for the while. So we will not create a deferred tax asset or a deferred tax liability on CSR because it's obviously a permanent difference. So whatever deferred tax credit we arrived above, that is this 1.2585, this number holds good. So when I just come down below, my net tax charge computation would be, so I say current tax as CT would be 31.4625 minus deferred tax credit to the extent of 1.2585. Yes, perfect. So what do I arrive at, guys? 31.4625 minus 1.2585, 30.204. Guys. We had, in our previous case, we had a current tax, we had a net tax charge of 25.17 rupees, which was perfectly matching to the effective tax rate that we were applying on our profit before tax. But here it's not matching. The investor will get afraid. Oh, what? We're applying 25.17 to 100, but it's not coming to 25.17. Sir, why is it 30.204? Sir, any person who doesn't know finance will ask, right? Right. That is why, to explain to an investor who doesn't know what is Ind AS 12, why does the tax rate exactly applied on the profit before tax does not match to the actual net tax charge, we have a concept called effective tax reconciliation, which will basically bridge the gap between 25.17 to 30.204. So guys, many of you would have studied BRS in your foundation, and I'm sure all of you are aware of BRS. So in BRS, you will try matching your balance as per passbook with the balance as per your cash book, and you will explain the reconciliation, right? So what is a reconciliation? A reconciliation is a reason for a difference. It is not an exception, guys. It is not an exception. I think the same logic holds good here. The difference between 25.17 and 30.204 is not an exception. So what we will try to explain to the investor is, sir, ideally, you should have, basis your simple logic, you should have got 25.17 of net tax charge. But sir, we are getting 30.204 of net tax charge. Sir, you don't worry, you don't take the tension. We are the financial experts. We will explain it to you, and that's what we are going to do here. So I'll start with my profit before tax. 100. What will a layman do? He'll say that my effective tax rate, which is applicable to the entity, is 25.17%. And he will arrive at the tax charge that should be appearing in the financials as rupees 25.17. Perfect. Now, but the tax charge net, that is my current tax charge minus my deferred tax credit, is coming to 30.204. Guys, think carefully. I told you something, right? My profit before tax is arrived after deducting 20 of CSR. So this 20 is being deducted in my books of accounts. So it would have basically been 120 minus 20, thereby yielding a profit before tax of 100, right? So when I'm applying 100 into 25.17, I'm applying the effective tax rate on a lower number of 100. But guys, we just saw above, right? We just saw above that we should add back the 20 in our tax computation. Why? What is the logic? Because the 20 is not allowed as a deduction in your income tax because it is a permanent difference. And since you are in the alternate tax regime, you don't also get the benefit of ATC, which is why it will be disallowed. So guys, now what am I saying? To the extent of CSR of rupees 20 into the tax rate, when I'm applying the tax rate above, this 20 would have been reduced because 100 is after reducing 20. But ideally, for arriving at my tax charge, which I should net tax charge, I shouldn't have deducted this 20. So I will say that 20 into 25.17 divided by 100 would give me 5.034. So guys, let's do a sense check here. We have a 25.17, which should ideally be the tax charge, but to the extent of 20 rupees of CSR, it should not be deducted from my profit before tax because it is a disallowance in tax. So I add it back to my profit before tax to the extent of 20 into 25.17. I'm sorry, I placed it here. Ideally, it should be coming here. So 5.034. So when I add 25.17 and 5.034, I get a tax charge of 30.204. Magical. So some of you might have a very basic doubt even after this as to why are the temporary differences not coming in my effective tax rate? Guys, we saw above that this 30.204 tax charge which we are taking is our current tax and deferred tax taken together. So for our temporary differences, for example, we saw our gratuity 43B here. So it was a temporary differences for which we created a deferred tax asset. So since we created a deferred tax asset on it, it is ultimately getting routed to the tax number that is coming inside, which is why it will not come as a reconciling item in your effective tax reconciliation, because it is already included in this tax charge number which is coming here, and it is also and it is also deducted in my profit before tax in arriving at my profit before tax. So again, it is, since it is there in my tax number which I'm having here and also in my tax number which is below, it is not a reconciling item. So guys, I hope this is clear. So guys, now let's do something really interesting. We're going to proceed to solve a question from November 22. Superb question, top-notch question. Guys, just a small disclaimer before we proceed to this question. So in this question, we might not be complying with the provisions of Income Tax Act 1961 because the question tells us to do in a particular way. So stay tuned, guys. In the next video, we'll be looking into the question. We'll be solving the question. We'll be acing this question. So revisit this video, take a look into it again, relax, rewind, rejuvenate, and come back stronger. All the very best. And last but not the least, the quote for the day: think like a CA, work like a CA, and ultimately you'll end up being one. So, guys, just a few days left. Start gearing up, start hustling. I think put in the hours, don't count the hours, because counting does not make a difference. What makes a difference is you sitting in, putting in the hours, even when you don't feel interested. Go for it, ace it. Cheers. And in the next video, we'll be doing an amazing question from November 2022 exam. And I have a gut feeling that this is going to come in May 25. But please, if it doesn't come, don't call me and ask me as to why it didn't come. This is just a gut feeling. Guys, I hope you understood the concept of effective tax rate. You will understand it even further because we're going to solve a beautiful question which is going to make everything crystal clear, give you a beautiful perspective into the standard, into the concept of ETR. Cheers. Stay tuned. Relax. Bye-bye. Take care.